Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the recession risk as we head into 2024. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com, where you can, of course, get access to the charts that we're going to talk about in this video. Now, you're probably familiar with the risk metrics that we have for Bitcoin and Ethereum and for the total market cap and so on and so forth. But we also have risk metrics to help us identify what is the recession risk at any given time. Now, one of the issues with understanding recessions and what are the likelihoods that they're going to play out is that upon the inversion of the yield curve, a lot of people think that means recession now, but historically, when the yield curve is inverted, it means recession later. Okay? And so a lot of people sort of front run this idea thinking that it has to happen immediately, whereas the context of history would say that's not actually true. But there's also a lot of different metrics that people look at. If you think about like on Twitter, seems like every single day there's someone tweeting out something about, some macro metric that just came in and they're talking about whether it's good or bad. Okay? There's so many things out there. It can be a little bit daunting, especially oftentimes when the market might not even react how you would think it would. Sometimes, upon bad news, the market goes up. Perhaps it's because the market is thinking that the Fed will pivot. Sometimes when you get good news, the market goes down because then the dollar is starting to rally, implying that we're going to have more rate cuts, more rate hikes. So it can be confusing, but I thought it would be useful to track various macro metrics and to look at historical rates of change to identify what is the risk of a recession at any given time to help us better identify when it's actually something we should be worrying about or not. We have this separated into 4 different categories. So we have employment risk, national income and product risk, production and business risk, and interest rate risk. Now, the only one of these 4 categories that is screaming there's something to worry about at this time is the interest rate risk. But this is also likely the only one that's going to give you any warning before it actually arrives. By the time unemployment risk would start to go up to high risk levels, the market's probably already priced it in. Okay? So what I want to do is we're going to start off with employment risk, and we're going to go through the different categories to see what are the trends that we're currently seeing. If you see right now, the only one out of all of these that is even elevated at all is continued claims. So let's go check out the employment risk. This is what the total employment risk looks like. Okay? And you can see that when it shoots up, right, when it starts to shoot up, it can give you a little bit of a warning, right? But if you wait for it to get, up to a high risk level, the market's already well off the highs. The same thing like over here in the dot-com crash. I mean, like if you waited for this thing to go up, the market would have already made a large portion of that move. Same thing like in the 70s. I mean, the market had already fallen off the highs by the time this thing was going higher. What's interesting, and this cycle has been difficult, is because sometimes you get these things, right, where like it goes up, but it only goes to a relatively low risk level and doesn't accelerate beyond that, right? So like in late 2018, the employment risk metric was starting to go up, but it did not go beyond that, and then it came back down. There's also other times in history where there are spikes in it, but it didn't necessarily mean recession immediately. Sometimes you get a spike only for it to then come back down and then spike a year later. Okay? Right now, if we sort of zoom into what's been going on, you can see that we started to go up and we hit about that 0.37 risk level or so. It's been trending down, but then ever since October, it started to go back up again. And so when looking at this, it might be helpful to identify where is that risk coming from. The total macro risk for a recession is made up of job openings risk, job quits risk, initial claims risk, continued claims risk, and the unemployment rate risk. So let's look at each of those individually to see where is that risk coming from. If you look at the unemployment rate risk, this is what it looks like, okay? And there are occasionally spikes in the unemployment rate risk. Here's a spike in 1986 that went up to about 0.0875. There's a spike right here that went up to about 0.09. Here's a spike in 1956 that went up to about 0.1 that did not necessarily correspond to a recession immediately. Here's another one in 1951 where it spiked up. But so there are occasionally spikes that don't lead us anywhere. But then sometimes you get spikes that take us all the way up to the higher risk band, right? Where it goes all the way essentially up to 1, implying that, hey guys, like this is a recession. And it is starting to go up, right? I mean, like you can see the unemployment rate risk has actually moved up a good bit recently off these lows. I mean, the risk up until September was below 0.02, and now it's all the way up at 0.08. So it has had a sizable move. And of course, it makes sense that it has, because if you look at the unemployment rate, it has in fact been moving higher. And if you look at a 3-month moving average of it, you can see that it's been moving higher. So it makes sense that the risk on this has gone up because, you know, one of the things that happens with the unemployment rate is a lot of times when it goes above, say, like its 24-month moving average or something, it just keeps going up, right? It doesn't tend to just go sideways, you know, for years and years and years. It'll either be trending down or be trending up based on oftentimes on you know, the sort of the aftermath of tighter monetary policy, and then the Fed will then cut to try to alleviate some of the issues that they brought on. So the unemployment rate risk is starting to go up, but it is still not necessarily at levels consistent with what we saw back in 2008 and in 2000 and so on and so forth. Job openings risk did go up a lot, but then it's actually come back down recently. Now, this is one that I think will be very interesting to watch next week. The reason why I say that, if you go look at job openings, you will in fact see that it has been a downward move, but of course, it is a stochastic process, right? It does not play out in a linear fashion. It often will go down for a little bit and then pop back up, and we've seen that happen again. And so next week, we're going to get more information on the labor market. And when we do, a lot of these risk metrics are going to be updated. So if job openings next week comes in well below expectations, then the job openings risk would go back up. The reason why it's fallen off of its July high is because you can see here that job openings went back up. So it really depends on if you think that job openings are continuing to drop, or if you think they're going to slowly start to reaccelerate now that we're potentially at the terminal rate. A lot of that depends on whether 5.5% is sufficiently restrictive, or if it's below R star, the neutral rate. If we continue on, we could look at job quits and see what that one looks like. We don't have as much history for that one, but it is somewhat elevated. But it's not any more elevated than it was back in 2022, or not much more than it was in December 2012 or October 2012 or in May of 2003. So this is another one that is elevated, but it's not necessarily in full-blown recession territory just yet. It doesn't mean that it can't turn into that, but it's not there just yet. Initial claims is the lowest one out of all the employment risk metrics. You can see that it is still relatively low. Initial claims, as I've said before, for us to really be in recession territory, they would likely need to be printing in the 300,000s, and we're still in the 200,000s. I did suggest that this could be a bottom over here, so we could start to trend up, just like we started to trend up around September, October last year, and then put in a higher low in January, and then continued higher into the summer. So if that trend continues, then we would also see the initial claims risk continue to go up. And then the last one, which is probably the one that looks the most concerning right now, is the continued claims risk. Okay. Now, again, this is one of those things where it can sometimes give false signals, right? Like here, if you look in 2019, it went up, but it did not give us a recession. Just like over here, when it went up in 2022, it did not give us a recession. But the next time it went up, it did. Okay. Now, it is starting to go back up again, and there's a good reason for that. And the reason, of course, is because if you look at continued claims, they've been moving up quite quickly, in fact. And actually, the recent report that we got just this past week was at 1.93 million. The last time it was at 1.93 million, you'd have to go back all the way to 2021. So what that sort of implies is that while initial claims are low, meaning the layoffs are still kind of going at the same pace that they have been for a long time, the people that are getting laid off are having a harder time finding a new job. That's what it at least implies to me. Otherwise, why would continued claims be going higher if initial claims have remained steady, right? As long as if the labor market were really as tight as it has been, then you would expect those workers who have been laid off to be able to find a new job. But if they're unable to find a new job because the job openings have been going down, then that's why it would make sense for the continued claims to start to go up. And the reason why that's relevant is because continued claims often leads the unemployment rate. If you go look at unemployment rate versus claims, and we just look here at continued claims and the unemployment rate, you can see oftentimes it is continued claims as it goes up. The unemployment rate will eventually go up if history is any indication, but it can lag, right? I mean, here continued claims were going higher and higher and higher, and then eventually the unemployment rate responded in kind. But it took a long time, just like it is today. I mean, like continued claims moved off the lows back in September 2022, and it seems like only in recent months has the unemployment rate even budged at all to the upside. So that sort of summarizes the risk of in the employment area. Okay, so it is elevated, right? It's 0.2. It's not like there's no risk of a recession. The risk is not as low as it was from 2010 until 2018, right? It's not like there's no risk or not nearly as much risk like there was in 2021, but it is elevated. And it should be something on your radar, right? It shouldn't be this thing that you say, well, Twitter's been calling for it forever, therefore it can't happen. The problem with Twitter is, you see an inverted yield curve, and a lot of people think it means recession now, whereas what I've maintained for a long time is what it often means is recession later. And you can always rally into that. That's a common thing that we see. So let's go look at another category. So the next category we'll look at will be national income and product. This category is not showing as many warning signs as the labor market is at the current time. To go through each individual one, if you look at real gross domestic product, you can see that the risk was going up in 2022, but ever since then it's actually come back down. The problem with this risk metric is that if you use it at tops to say that there's no risk of a recession, it can often not be sort of the greatest tool to use, right? Or sorry, at bottoms, right? It's like if you were to look at this and look at it when it's relatively low, like over here, and if you say, oh, well, the risk is low on this, that means there's no recession. Well, I mean, just look at what happened right after it. So some of these risk metrics are a little bit more useful, like, in terms of trying to plan on what's likely going to happen. Like if you look at continued claims and the unemployment rate, and then other things like GDP is one of the most lagging indicators to look at. And by the time it hits this peak, right, that often corresponds to sort of a low in the market, right, when the risk is at its highest level. Of course, it's only obvious in hindsight. There's real gross domestic income. This one has been moving up. It has pulled back a little bit recently, but still the risk on real gross domestic income is higher than it has been. I mean, if you exclude the pandemic, it's higher than it's been since 2008 and 2001, right? And these prior recessions. So this is something that is also worthwhile to keep an eye on. A lot of these things we only get updates every single quarter. So you're not going to be getting an update on these risk metrics as frequently as you might want, but that's just the nature of the data. There's also real gross private domestic investment. That risk remains relatively low at the current time. Again, if it's low, it means it's not really screaming recession. If it's high, it's screaming recession. There's also imports of goods and services. That one is a little off its lows here. Okay, so I mean it should have your attention in the sense that if you go look at imports in general, like if you look at imports of goods and services, I think it did trend up a little bit in the most recent report that we got. We actually got a report not that long ago, in fact. And when we got it, I do believe that it actually went up a little bit, and so did exports. But while it has gone up a little bit, it still has been trending down ever since March of 2022. And if you look at a year-over-year percentage change of this, it is negative, and you can see when it does go negative, it can often correspond to recessions, although that's not entirely always accurate, because you can see like in 2015, 2016, we had a recession scare, but we did not actually have a recession. And so it's negative now as well. And that's one of the reasons why you can see that the risk is slightly elevated here, is because it has been moving down recently, even though the last data point was up. There's also federal government tax receipts. The risk there is somewhat elevated. One of the reasons for that is if you go look at federal government current tax receipts and we see, what are the trends going on there? I mean, it fell well off of these highs over here. And if you were to look at a year-over-year percentage change, I mean, it's fairly negative. It's fairly negative. And that's one of the reasons why the risk level is elevated, is because historically, when it's negative, it means there's some risk there that a recession could materialize, right? You can see historically when it is negative, that's often corresponds to these gray shaded regions, which of course correspond to recessions. If you look at real gross national product, that risk is relatively low, and it's actually been trending down since April of 2022. So that one is not screaming from the rooftops. And then you have real gross national income, which the risk has moved down recently, but still overall the risk remains elevated under the context of history, especially if you exclude the pandemic. The last time the risk on this was this high was during prior recessions, for the most part. And actually, I don't think we've ever seen the risk on this go up to 0.495 without there being a recession. Okay, so just something to consider. So that covers these two categories. The next category we'll cover will be production and business. And then the last category, which tends to be the most predictive, will be interest rates. So production and business is arguably the one that is showing the least concern. Total macro risk here is relatively low. If we look at total industrial production index, it's relatively low. Real manufacturing and trade sales, again, relatively low. And total business inventories, risk is somewhat low. Although I could see this one going up in the not so distant future, primarily because I think a lot of inventories got brought forward, and that was one of the reasons why GDP was so high in Q3. I think a lot of companies sort of brought that forward, and that might be something that's lacking in future reports. But again, the total macro risk on this one is actually relatively low, and it might be the lowest one. Yeah, you can see the risk is only 0.016. I meant to show you the total macro risk on this one, so I'll go ahead and do that. It's currently at 0.172. So the last one that we'll talk about here is interest rate risk. And this is the one that is probably the only one that has predictive power in the sense of giving you, potentially up to a year's notice. And even then, it doesn't always work. And I think a lot of people it gets frustrating because you want a signal that just tells you what's going to happen when. But investing is not a perfect science, and especially macroeconomics is certainly not a perfect science. There's a lot of people that are much smarter than me that I follow in the Macroverse, and it seems like a lot of them don't agree on anything. So it's a difficult game to navigate. Everyone has a different opinion on the way things are going. If you look at interest rate risk, it's relatively elevated right now. I mean, and historically, when it's elevated like this, it tends to correspond to a recession. But it does not mean recession now when it goes up. This risk on here went up and hit these higher risk bands. It first went into the 0.9 risk band back in November of 2022. I mean, essentially, you're talking about a year ago. But if you look at some of these other recessions, right, when it first got up into the 0.9 risk band here, it was June of 89. The recession didn't arrive until about 13 months later. If you look in the financial crisis, it first got into the 0.9 risk band in April 2006. The recession did not arrive until December of 2007. I mean, you're talking a year and a half later before it arrived. You can go look at other examples as well. Here, it first got into the 0.9 wristband in July of 73. The recession did not arrive until November, about half a year later. In 1979, the risk level on here went to the 0.9 to 1 wristband in February of 79. The recession did not arrive until January of 1980. So there's a lot of examples, and again, one more, it got up elevated in November of 1980. Recession did not arrive until June of 1981. So again, a little over half a year. So the problem, guys, last cycle, this was elevated as well. We had an inverted yield curve in 2019, and then I remember thinking like, oh, it doesn't really mean that much. We're not going to have a recession. There's not going to be one. And then we had one. And so there's no guarantees, right? There's no guarantees that we're going to have a recession. I want to be clear. Like, there's always a chance that the Fed engineers a soft landing, even though it's not the most likely outcome. It has previously occurred, like in 1967. But even in 1967, when they engineered a soft landing after an inverted yield curve, we still ended up getting a recession. It was just delayed by another couple of years. So the Fed does not have the best track record in terms of engineering a soft landing. So again, I mean, here we've gone up into the 0.9 to 1 wristband about a little over a year ago now. Okay, so it's relevant to think that there is a lag time on this stuff, and it's hard to know exactly what that lag time is. Sometimes it's 6 months, sometimes it's 12 months. It's even been 18 months in the past, which if that's the case, then it means it could still be another, 5 or 6 months away. So when we look at this stuff, like the only one that really gives you any lead time is the interest rate risk. It's the yield curve. The other one that is starting to show some concerning signs are, again, things like, the continued claims risk, which is starting to go back up, and the unemployment rate risk, which is starting to go back up. But even in those cases, there are occasionally false positives where it looks like it's going to go higher, only to then stall out and the risk to go back down. So I think that's what makes macro investing so hard, or even predicting the macro, is you can look at this stuff and drive yourself crazy waiting for these things to play out. I think trying to time things based on recession is a difficult game to play, honestly. I feel like almost always you're going to be better off just coming up with a DCA strategy for what you're interested in and then just sticking to that. And even if it would have worked out better to just sort of wait or something, you also have to sort of weigh in, well, was it worth all the potential sleepless nights of waiting for this thing to sort of play out? So I think, my view is that it makes sense to have some cash in case a recession arrives. That's my view. But it doesn't make sense, in my view, to be 100% cash. And I've been clear about that forever, right? It makes sense to be hedged. To say, you know what? If this recession happens, then the only way you're going to benefit from it is if you have money to, quote unquote, buy the dip. If you're fully invested, which, by the way, people fully invested this year have done really well, right? So it's no knock against them. I have not been, I have not had all my money in the market. I've been hedged both ways, but I certainly haven't had all my money in the market. But the people that did have made a lot of money, right? But again, the way to be hedged going into something like this is to have some cash in case this keeps going higher. But to be 100% could also be seen as foolish, in case it doesn't materialize again. So that's the different risk metrics, and I will continue to follow them. You can get access to them via Into the Cryptoverse Premium. We are running the sale right now. Links in the description below. You can use the code Cyber Monday to get 50% off your first month. The last thing I want to talk about is I want to talk a little bit about the bond market and yields, because Powell has come out and has said that they could raise again, and that they're not really thinking about rate cuts. I think he said that today. And the way the market responded was to now assume that the first rate cut will come in March. You can see that the market now thinks that there's almost a 50%, a 56% chance that we're going to get this cut in March. But it's more than that, really, because there's an 8.5% chance that we're going to get 50 basis points of cuts by March. So realistic, or relative. I mean, if you look at this, there's a really high chance, right? I mean, you're talking like a 63% chance or so, somewhere around there, 63, 64% chance that you're essentially going to have a rate cut by March 2024. Why would the market think that? Powell has clearly said that's not what they're going to do. Well, I'll tell you why the market would think that. It's because the market is probably looking at the unemployment rate and saying, we don't believe you, to the Federal Reserve, right? That's probably what they're saying. They're saying, we don't believe you. Because you can talk all you want to, but what are you really going to do when we get into an election year and the unemployment rate is above 4%, and you're sitting here talking about how you're going to keep raising rates? I said a long time ago, I think the terminal rate is 5.5%. That has been my target for like a year and a half? And that's where they are. I don't really think they need to go higher. In fact, I would argue that if they were to go higher, that could be seen easily as a policy mistake. I'm sort of assuming that 5.5% is above the neutral rate, which I could be wrong about. I could be wrong about that. It's possible that the economy is even stronger, but I think there is reason to believe that 5.5% is sufficiently restrictive. And the reason why it might be appropriate to believe that is because the unemployment rate is starting to make a move here. If you look at, if you were to go take a look at the unemployment rate, and if we were to overlay, let's overlay a 24-month moving average. Normally, when it breaks through the 24-month moving average, it keeps going up. Like it doesn't tend to break through it and then just be like, oh, just kidding. We're not going to keep going up. Are there some times where that's happened? I'm sure we can find some, and we'll go through it right now. Right? Last time it did it, it was just straight up. Right? It did not hang out at all at that level. Here, it broke through, it just kept on going. Here, it broke through, it kept on going. When it broke through right here, it hesitated for a little bit, but it still eventually kept on going. Here, kept on going. Here, same thing, right? Here's an example. This is that soft landing scenario I told you guys about earlier. Do you remember when I mentioned 1967? Here's the example where it broke out only to then go back down. The counterpoint to this, though, is that when it broke out here, the unemployment rate had only gone to 3.6. And then eventually it broke all the way down to 3.4. We've already hit 3.4, right? We've already hit 3.4 over here. So you could argue that we've already gone down to this level. If it were to play out like this, then it would mean that this is a fake out and then it's just going to go back down. Okay? I don't know what's going to happen. I mean, you can ask me what I think is the most likely outcome. I would say, well, if you look back at all these prior recessions, I'm not going to say that, this one is the most likely outcome, because every other time when it happens, the unemployment rate just keeps going up, So I'm not going to look at like 1 out of 10 and say that, all right, that's the most likely outcome. I'll say, no, every other time it's broken above this, it kept on going, right? There's 5, 6, 7, 8. So you have 9 examples right here. One of them was a fake out. What will number 10 be? Is it a fake out? I don't know. I don't know. You could make the case either way. I mean, you could say that, the pandemic changed everything and the labor market is more resilient. You could talk about all sorts of things. But the probability is higher that the unemployment rate continues going up. That doesn't mean it has to go up next month, right? But it could. I think the market over here is acting like we're going to get a 4% on the unemployment rate next week. That's what it seems like the market's acting like to me. I mean, again, you have Powell coming out and saying they're not talking about rate cuts and they're prepared to raise again. And after he said that, the probability of a rate cut in March went up. It went up. The market does not believe him. The bond market doesn't believe him. Look at the 10-year. Look at the 10-year. This is something we can talk briefly about. But the problem here is the 10-year is tanking. It's back down to 4.2%, 4.22%. Now you might wonder, how is that relevant? Well, if the long end of the yield curve has topped, right? I mean, if the long end is not going to go any higher, then it means the market no longer believes higher for longer. Okay? If you remember just a few weeks ago, the market went up to over 5%. Like the 10-year went over 5%. And I was saying that it likely would. And back then, my expectation was that this could be the top. This is what I was talking about in ITC Premium, is that this could be the top on the long end of the yield curve. It is possible you could get one more push if the unemployment rate pulls in 1967 and goes back down on us. Like, there's a chance that that could happen. But this is at least a candidate for the top in the 10-year yield, at least in the short term. Now, over the next decade, we could, of course, go much higher in the 10-year if structurally we're just going back to a period of higher interest rates. But the reason why it's important to sort of at least think about these things with a 10-year yield and where the S&P is you can see that the S&P has rallied. The reason why this isn't really lining up, because I've moved it around, right? I've moved the S&P around like it was previously, like that. But the reason why this is relevant is because normally after the 10-year tops, risk assets rally. That's normally what happens. Why? Is because it takes that pressure off the stock market. If you go look at the last two recessions, you can see here the 10-year topped in June of 2007. And then the market, the S&P, topped in October of 2007. So initially, while the 10-year was going down, the S&P got a rally. But then eventually, as the 10-year continued to go down, the S&P eventually followed. It's the same thing like in the dot-com crash, right? Right here, you can see that the 10-year topped in January. For a little bit, the S&P rallied into March. But the problem, and then it still rallied all the way out until August. But I think it was a lower high, at least on the closes. Maybe the wicks were higher, I don't know. But the problem is that as while the 10-year went down here, as it kept going down, the market eventually followed. The reason for that is because if the 10-year keeps going down, it's basically saying something's wrong with the economy, right? Like something's wrong and the Fed needs to come to the rescue and fix it. Okay? That's what the economy is. That's what the market is currently saying with such a big drop. If the unemployment rate were to come in at, if it were to go back down next week, and in January, if it started to trend back down, then yeah, like you could get another push higher in the long end of the yield curve. And maybe they go above 5.5. But I don't really think they need to. I think that 5.5 is sufficiently restrictive as long as they're willing to hold it there. Then the counterpoint is, well, why are risk assets rallying if the economy is in trouble? That's what normally happens. I mean, normally after a Fed pause, the market rallies a lot. I mean, I think a lot of times the market can rally 15, 20% after a Fed pause. Even here, we just showed two examples where after the 10-year tops, the market rallies for several months before it eventually falls down. There's no guarantee that it's going to play out like that again. It's all obvious in hindsight. Like, there's no guarantee that this is the top in the 10-year. But if this is the top in the 10-year and it just continues to drop like it is now, then eventually the S&P will take notice and say, all right, the reason it's dropping is because the unemployment rate's going higher, the economy's starting to fall apart, and the Fed's behind the curve in doing something. They're behind the curve in doing something. So that's why I think the market doesn't believe the Fed. The market is saying, to hell with another rate hike. We got you for a rate cut as early as Q1. As early as Q1. It makes sense if you think about it, because the unemployment rate's going higher, continued claims are starting to go up, and next year's an election year. It's an election year next year. Why do you guys, I'm going to sneak it in, why do you think the Bitcoin dominance often tops out around the halving year? It's because it corresponds to the election year, and we then often go to looser monetary policy. Do you think an incumbent's going to want to go into the election with the unemployment rate going up and interest rates elevated and no sign of relief in sight, no, there's going to be political pressure to go to looser monetary policy, despite what they say. And guys, I'm saying this as someone who previously told you when most market participants were completely against the idea of 5.5%, right? I mean, I think when interest rates were like 1%, I think I said it's going to go to 5.5%, 5 to 5.5%, because it needs to get well above inflation, and by that time it should be well above inflation, right? So as someone who said that, right, as someone who said 5.5% is the likely outcome, and that higher for longer will likely be the case, it has been. But I think the thing is that you have to consider is that I think higher for longer finally got priced in when the long end of the yield curve shot up over the last few months. I think the main thing to sort of keep us on our toes is what happens if the labor market next week surprises to the downside, meaning like unemployment rate falls and then job openings go up, right? Like if something like that were to happen, then it is possible that the long end of the yield curve could go back up, and then it's possible that the Fed has to keep on raising. But if the trend remains intact, right, if unemployment rate continues to go up like it has been, by the way, some sectors look worse. Like, I mean, look at like 16 to 19-year-olds. This thing is going up quickly. I mean, just in April, the unemployment rate for 16 to 19-year-olds was at 9.2%. Today, it's at 13.2%. I mean, this is not a healthy move here. This is moving up quickly. The problem is if the Fed were to cut tomorrow, it's not like this thing is necessarily going to stop going up, right? I mean, in the same way that rate hikes operate with long and variable lags, so too do rate cuts. And so there is an argument that if you believe that the Fed has engineered a soft landing, right? Like if you're in the soft landing camp, then I think it would be reasonable to expect that the Fed would need to cut to maintain the integrity of that argument. Because as the effects of all these interest rates finally get, as the economy feels their full wrath, if there's not something trying to help offset that, then that's how you could get a hard landing. So, is it possible that the Fed could achieve a soft landing? It's possible. 1967 shows us that it's possible, and it would be foolish to sit here and say that it can't happen. But on the other hand, every month, every meeting that goes by where the Fed does not cut, I think the risk of a hard landing goes up. And it doesn't look like they're cutting in December, right? I mean, there's a 97.5% chance that they hold. I don't think there's much of a chance that they cut in December. The only way that they would cut in December is something catastrophic happens between now and then. Then they would cut. But let's assume they don't cut in December. Let's assume they don't cut in January. This is at 14%. I just did a video for the ITC premium stuff, and this was at 0% just a few days ago. And I said that this number right here is likely going to start going up as people start to get worried about the labor market. And now it's at 14%. Again, it's not the most likely outcome to get a rate cut in January, but you have no rate cut in December. If you have no rate cut in January and you're in March and the Fed still hasn't cut, the market will make them cut, more than likely, right? The market will eventually show some type of weakness, assuming the labor market continues to show weakness, and then the Fed will respond in kind. One thing I wanted to say is that, when you look at these charts, it often might not make sense, or when you look at this table, it might not make the most sense because you're like, well, if it's a soft landing, this is probably too many cuts. But if it's a hard landing, it's probably not enough cuts. I mean, if we get a hard landing, is it really sufficient by July that we're still going to be at 4 3/4? Probably not. I mean, like if we get a hard landing in the first half of 2024, the idea that we'd be at 4 3, 4.75 would be far. I mean, that'd be too high, right? So I think what you're looking at is essentially a bimodal distribution. You're looking at a bimodal distribution where there's two outcomes that investors are preparing for. One of which is a soft landing, which essentially means there's going to be like very few rate cuts, if any, And then there's other people betting on a hard landing, saying that no, it's going to be very, very bad, and we need to prepare for that. And so what you get is a mixture of the two. You don't really get what you don't really see what it is if we get a hard landing, and you're not really looking at it what it's going to be if we get a soft landing. You're looking at investors' expectations. It's a mixture of both outcomes. So the reason why these probabilities might not match up with what you would consider for a soft landing or a hard landing is because it's a bimodal distribution where you have, probabilities going to two separate peaks based on whether it's a soft landing or a hard landing. So you're getting to see kind of what's in between. So what you're looking at is probably not what's going to happen. Okay? It's probably not. If we get a hard landing, the market is not pricing in enough rate cuts. If we get a soft landing, then why would the Fed go all the way back to 4%? I mean, maybe they would go back to 5%, but they're not going to go back to 4% if we get a soft landing, more than likely. So again, bimodal distribution, I think that's the reason why it looks somewhat in between what both camps are expecting. So hopefully this video has been at least somewhat useful in trying to help identify the recession risk. There's a lot of things to consider with recession risk. The interest rate risk is the most elevated, but it's often elevated for 6 to 18 months before a recession arrives. And we've had an inverted yield curve. The 3-month and the 10-year has been inverted for about a year. The 2-year and the 10-year has been inverted since July of 2022. And it even had a brief inversion in April 2022, I think. So July, I mean, you're pretty quickly coming up on a year and a half, right? I mean, because it's already been August, September, October, November, December. I mean, as we get into next year, you're already looking at a year and a half in terms of the yield curve being inverted. This is the one screaming the most, but it often screams like crazy for 6 to 18 months before anything happens. Production and business, it looks like things are fine right now, okay? National income and product, some of the categories are fine, but other ones not so much, like tax receipts and gross domestic income. Frankly, they have somewhat elevated risk levels compared to the context of history. I mean, again, if you look at tax receipts, like when the risk is this high, we've never had the risk on this be this high without some type of recession ensuing. And then employment risk, still relatively low, but some of them are trending in the wrong direction. Some of them are trending in the right direction. Initial claims has been going in the right direction, right? They've been dropping or staying relatively flat. So you see initial claims, the risk was elevated and then it just came back down. Continued claims, it was elevated and then it came back down and then now it's elevated again. It's starting to go back up again. So it's a hard market, guys. I mean, there's been a lot of signals in various parts, and some people have described it as like a rolling recession where it's hitting various sectors at various times. Like it hit the tech industry at the end of 2022, and then it's hitting other industries in 2023. Maybe it'll hit different industries in 2024. I think there's some merit to that idea as well, but there's a lot to consider. I'm not here to tell you what has to happen because the truth is I don't know, okay? I'm here to talk about the risk associated in these markets so that you can better understand, how you might want to navigate financial markets. There's always a risk. Just consider what the risk is. If you guys want access to all this stuff, again, check out Into the Cryptoverse Premium at intothecryptoverse.com. We are still running the sale. We'll run that for a little bit longer, and you can still use the Cyber Monday code, although I think that ends on December 3rd. So that'll give you 50% off your first month. Thank you guys for tuning in. Give the video a thumbs up, and I'll see you guys next time. Bye.